Welcome to the Deep Dive. Today, we're going to dive headfirst into the world of intraday trading.
Oh, yeah.
And we've got this book here that claims to unlock the secrets of smart money. So those institutional investors that really kind of make the markets dance to their own tune.
Right.
It's like having a trading mentor in your pocket ready to just kind of spill the beans on how to read those footprints
Yeah, for sure.
of the big players.
Yeah, it's not just about mimicking their moves, though.
Yeah.
This book really gets into, like, the why behind those moves.
Oh, interesting.
The psychology,
Yeah.
the strategies that really drive these institutions.
I see.
And it's knowledge that you can apply whether you're a scalper,
Okay.
a swing trader, or even if you're more into long-term investing.
That's what makes this deep dive so fascinating, I think. This isn't just for day traders, right?
Right.
This is about leveling the playing field no matter what your trading style is.
Exactly.
Or your experience level.
Yeah.
We're going to unpack some really intriguing concepts like liquidity traps,
Well-
a three drives pattern, and even something called the Judas swing, which sounds pretty dramatic.
Yeah, and it can be dramatic, especially if you're on the wrong side of it.
Oh, I bet.
But that's where this knowledge becomes power.
Okay.
By understanding how the smart money operates,
Right.
you can start to anticipate their moves
Yeah.
and potentially avoid those like costly mistakes that just wipe out most retail traders.
Yeah, absolutely. And speaking of retail traders,
Yeah.
the book dives right into this world of intraday trading.
Uh-huh.
But before we get into like all the institutional secrets,
Okay.
let's just set the stage here.
Sure.
Why might someone choose this like fast-paced style over, say, the buy and hold approach?
Well, intraday trading, as the name suggests, just means opening and closing your positions within the same trading day.
Got it.
The allure. Well, you're not waiting weeks or months for a trade to play out.
Right.
It's about capitalizing on those short-term price swings, which means more potential setups, more opportunities to enter and exit the market.
So it's all about speed and agility.
Yeah.
Sounds like we're training for the trading Olympics here.
There's definitely a certain mindset and skill set involved,
Right.
but, the book really emphasizes that the real key is understanding the psychology of that short-term thinking.
Interesting.
It even gives this compelling example. Imagine mastering how to consistently profit from just 5 handles.
Okay.
Think of them as price movement units
Got it.
in the E-mini S&P,
I see. Okay.
It's not about, getting rich quick.
Right.
It's about consistently exploiting those smaller moves that the market just gives you day in and day out.
That's a really specific example that makes it click for me.
Yeah.
I like that.
And what's fascinating is once you master that short-term thinking,
Okay.
the book argues that you can scale those principles to longer time frames too.
Oh, interesting.
So even if you're not an intraday trader, these insights can really kind of elevate your game no matter what your style is.
Got it. Okay. So we're starting to see why this intraday mindset is so valuable.
Yeah,
But let's get practical here.
sure.
The book mentions micro contracts as a way to kind of dip your toes into this world
Right.
without risking a ton of capital.
Exactly.
Tell me about those.
Yeah. So micro contracts are essentially smaller versions of those standard futures contracts,
Okay.
allowing you to trade with less capital at stake. It's a
Right.
great way for beginners to get a feel for the market without, risking their entire account on a single trade.
So it's like a training ground where you can learn the ropes and test your strategies
Exactly.
without the pressure of those huge losses.
Yeah, and
Right.
then once you've honed your skills and gained some confidence,
Yep.
then you can gradually scale up to those larger contracts.
Okay. That's a smart approach, especially for somebody brand new to intraday trading.
Yeah.
But let's get into the meat of the book here.
Okay.
It talks about analyzing weekly candle movements and swing highs and lows to understand market bias.
Right.
Is that part of building our trading plan?
Absolutely. Before diving into those rapid-fire intraday trades,
Right.
it's crucial to understand the broader market context. Are we in an uptrend, a downtrend, or just range-bound chaos?
Right.
This weekly analysis helps you pick your battles and trade in harmony with the market's direction.
Okay, so it's like setting the stage before the main act begins.
Exactly.
Makes sense. Now, this is where it gets really interesting for me. The book talks about institutional swing points.
Yes.
And these aren't your average swing highs and lows, are they?
No. These are price levels where smart money, those institutional investors, are most likely to step in and manipulate the market. It's not just about price bouncing off a previous high or low. It's about understanding where those big players can exert their influence.
Okay, now manipulation sounds a bit shady.
Mhm.
What are they actually doing at these points?
Think of it like this. They're playing a strategic game, and we're trying to understand their playbook. They're often looking to trigger stop-loss orders of other traders, especially those who are less experienced and predictable.
So they're deliberately pushing the price to certain levels, knowing that it will cause a chain reaction of sell orders.
Exactly. And by understanding this game, you can avoid being caught in those traps. The book actually highlights specific visual cues on the chart to identify these institutional swing points. Look for a key level that price fails to react to immediately, followed by a sharp reversal. It often forms a V shape on the chart.
So it's almost like a fake out, right?
Yeah.
Making you think the market's breaking out, but then bam, it reverses course,
Right.
taking out those stop loss orders, creating opportunities for those who are in the know.
Precisely. And the book outlines two main strategies for trading around these institutional swing points. The first is waiting for a market structure break. This is a decisive move that breaks through a key support or resistance level, indicating a true shift in momentum.
So you're waiting for confirmation that the market is truly committed to a new direction,
Yeah.
not just a fake out designed to trigger those stops.
Exactly. The second strategy is identifying a failure swing pattern. This happens when price tries to push through a key level but lacks the momentum to sustain the move. You see price poke its nose through the level but then quickly retreat, forming a sort of half-hearted breakout.
So that lack of follow-through is a warning sign
Right.
that the market's about to reverse.
Exactly.
Almost like they're testing the waters
Yeah.
before making a real move.
That's a great analogy. And with a failure swing pattern, you're looking to enter a trade in the opposite direction of the failed breakout, anticipating that the market will revert to its previous trend.
Okay, so we're starting to see how these institutional swing points can give us an edge.
Yeah.
But now let's talk about something that affects everybody in the market.
Sure.
Big or small?
Uh-huh.
Liquidity.
Yeah.
What is it?
Liquidity is often described as the lifeblood of the markets. It refers to how easily you can buy or sell an asset without causing a drastic change in its price. Think of it this way. Cash is extremely liquid because you can easily exchange it for goods and services without much friction.
Makes sense.
Yeah.
So a highly liquid market is like a well-oiled machine.
Yeah.
Things are flowing smoothly.
Uh-huh.
But how does this apply to trading and why does it matter to us?
A liquid market means there are plenty of buyers and sellers at any given time. This translates to faster trade execution and tighter spreads, which means lower trading costs for you. You don't have to worry as much about slippage, that frustrating difference between the price you expect to pay and the price you actually end up paying.
So in a liquid market, you can enter and exit trades quickly,
Right.
efficiently,
Yeah.
without worrying about those price surprises.
Exactly.
That's a huge advantage, especially in intraday trading.
Absolutely. And it's equally important for those big institutions. They're moving massive amounts of capital. So they need a liquid market to execute their trades without causing major price disruptions.
Okay, so we all need liquidity.
Yeah.
But the book seems to suggest that these institutions don't just rely on it.
Right.
They use it to their advantage.
Uh-huh.
Can you unpack that a little bit?
Yeah, remember those institutional swing points we talked about?
Yes.
Well, they're often areas where liquidity is concentrated. Think of it like a watering hole where the big predators gather, knowing that's where their prey is most likely to be found.
So they're deliberately targeting those areas where stop-loss orders are piled up,
yeah.
knowing they can trigger that cascade of selling,
Mm-hmm.
create those volatile moves that benefit their strategies.
Exactly. It's a bit like a chess game where there's several moves ahead, anticipating the reactions of other players.
And knowing this is how we level the playing field.
Right.
If we understand their tactics, we can avoid being the pawn in their game.
Precisely. The book actually goes deeper into specific strategies for identifying liquidity pools and recognizing the telltale signs of manipulation, which we'll discuss later in this deep dive.
That's what I'm excited to unpack.
Yeah.
But for now, I'm still wrapping my head around this idea
Yeah.
that what seems like random market chaos actually has this method to the madness.
Right.
It's like realizing there's a puppet master
Yeah.
behind the scenes pulling the strings.
And that's what makes this deep dive so powerful. We're starting to see those strings and learning how to anticipate the puppet master's moves. But we've only just scratched the surface. We've
Right.
got a lot more to uncover.
Okay, and we'll do that right after a quick break.
Yeah, and one of the most revealing concepts is this idea of liquidity traps.
Okay.
These are those areas on the chart where market makers create this illusion of market direction,
Right.
luring retail traders in just before a sharp reversal.
So we've talked about market manipulation in general, but this is like a specific tactic. How do we even start to spot these traps? It's not like they come with, warning signs flashing on the chart.
They don't, but the book emphasizes a key principle. Always zoom out and look at the bigger picture before diving into those shorter-term trades. Specifically, look for clear shifts in market structure on higher time frames, like a major support or resistance level that's about to be tested.
So we're not just looking at the 5-minute chart like a day trader might.
Exactly. Context is key.
Got it.
And once you've identified that key level on the higher time frame, watch how price action behaves around it on the lower time frame. Market makers often create those bubble-bursting scenarios we talked about around those classic support and resistance levels.
So if we see a breakout or what looks like a strong move toward a key level, we shouldn't just blindly jump in.
The book actually gives this pretty stark warning. Don't buy at the break of an old high or sell at the break of an old low when you're in one of those potential trap situations.
That's a powerful rule of thumb.
Yeah.
It's tempting to chase those breakouts, but it's a reminder to be patient.
Right.
Wait for confirmation.
Exactly. It might be a genuine breakout.
Right.
But it also could be a beautifully set trap.
Oh, yeah.
By the market makers.
I see. So being skeptical, especially around those key levels, is crucial.
Yeah.
Now, we've talked about institutional swing points. We've talked about these liquidity traps. And the book also talks about identifying liquidity pools.
Yeah.
How do those fit into the bigger picture?
So think of liquidity pools as these clusters of orders, both buy and sell orders, that are concentrated around specific price levels. They're like magnets for market makers.
Because they know that's where they can cause the most disruption, the most volatility.
Exactly.
Those pools are full of stop-loss orders just waiting to be triggered.
Exactly. And remember, their goal is to trigger those stops, creating momentum in their favor.
Wow, this is starting to feel like we're piecing together a puzzle, seeing the market from a whole new perspective. But let's move on to a pattern that I'm particularly intrigued by. The 3 drives pattern.
Oh, yeah?
What makes this pattern so special?
Yeah, this pattern is almost like a fingerprint, a telltale sign that institutions are quietly accumulating a position before a big move. Imagine a shark circling its prey. It's not a sudden attack. It's a calculated, patient approach.
So instead of a sudden spike in price, we're looking for a more controlled, gradual movement.
Exactly. The pattern itself consists of 3 distinct drives or price swings. Each drive typically makes a higher high and a higher low, showing this gradual buildup of buying pressure. But remember, this can play out in reverse with lower lows and lower highs if smart money is distributing a position.
So it's not just about the pattern itself. It's about understanding the context.
Right.
The bigger picture of whether the market's likely to be moving up or down.
Absolutely. And the book suggests that if you see those 3 drives heading towards a liquidity pool, even if that pool hasn't been fully hunted yet, a significant move is likely.
So it's almost like we're front-running the institutions, anticipating their next move based on this pattern.
Yeah, that's the power of understanding these concepts. But remember, it's not about guessing. It's about recognizing those patterns and understanding those forces at play.
All right. So we've covered liquidity traps, market maker manipulation, and the 3 drives pattern. The book also dives into a very specific trading strategy focused on the morning session.
Oh, right.
I'm curious, why this time of day? What's so special about those first few hours of trading?
Well, the morning session, particularly the period between 8:30 a.m. and noon Eastern Standard Time, is known for its high volatility and large price swings. It's prime time for those institutional players to make their moves.
So if you're an intraday trader, this is where the action is.
Exactly. And the book provides this really detailed strategy for capitalizing on this morning volatility. But we can boil it down to a few key steps. First, before the market opens, identify a liquidity pool on your chart.
So that's our target area, the place where we're expecting the fireworks to happen.
Then what?
Next, switch to a lower time frame chart, like the 5-minute chart, to get a more precise view of price action as the session unfolds. You're looking for a clear displacement in price movement below the pool. A sharp move that indicates a potential shift in momentum.
So we're watching for that initial spark that suggests the market is waking up and ready to move.
That's a great way to put it.
I like that.
And finally, use the fair value gap concept to pinpoint your entry point.
Okay, now remind me about fair value gaps.
Remember those gaps on the chart where price jumps, leaving an unfilled space?
Like a price vacuum that the market often wants to fill? Precisely, the book outlines strategies for identifying and trading those fair value gaps, which can be very powerful when combined with this morning session setup.
So we're using a combination of pre-market analysis, real-time observation,
Right.
and a specific entry technique to exploit the volatility of that morning session.
Exactly.
It sounds like it requires a lot of focus,
Yeah,
quick decision-making.
it does. And the book cautions that this is a high-risk, high-reward strategy.
Right.
The potential for profits is there, but so is the potential for losses.
Yeah.
Risk management and discipline are absolutely essential.
That's a good reminder. No trading strategy is foolproof.
Right.
There's always that element of risk, and it's important to manage it effectively.
Yeah.
But this morning session strategy sounds like an intriguing tool to add to the toolbox.
Yeah.
Now, the book also introduces this concept called the power of three. Sounds pretty dramatic.
Yeah, the Power of Three is a really powerful framework for understanding market cycles, and it applies across all time frames, not just intraday trading. It consists of three distinct phases:
Right.
accumulation, manipulation, and distribution.
Okay, these terms are starting to sound familiar
Right.
from our discussion about market maker tactics.
Exactly. It's all connected. Remember how we talked about institutions accumulating positions?
Yeah.
Manipulating price to shake out those weak hands, and
Mhm.
then distributing those positions to unsuspecting retail traders at a profit.
Classic pump and dump.
Exactly. The Power of Three concept helps us visualize these stages as they unfold in real time.
Got it.
During accumulation, institutions are quietly building their positions,
Okay.
often in a sideways or range-bound market. They're not trying to draw attention to themselves, just patiently buying up shares or contracts at favorable prices.
So it's like they're stealthily setting the stage
Right.
for the big move.
Exactly.
What after the next?
Then comes manipulation, the phase where things get really interesting. Once they've built a substantial position,
Okay.
they start to manipulate price action, often creating those fake breakouts or triggering stop-loss orders
Right.
to create the illusion of momentum and draw more buyers into the market.
So they're playing on those emotional biases,
Yeah.
fear and greed,
Uh-huh.
to create the conditions they need for that final phase.
Exactly. And once they've generated enough momentum, they move into distribution.
Okay.
This is where they unload those accumulated positions at a much higher price, often to the very retail traders who were chasing the momentum they created.
Right.
It's a sophisticated game.
It is.
But by understanding these stages,
Yeah.
you can start to anticipate their moves and position yourself accordingly.
This is making me think about that saying.
Yeah.
The market is a device for transferring money from the impatient to the patient.
Right.
It seems like those who understand this power of three concept have a huge advantage.
Absolutely. It's all about recognizing those patterns and understanding the psychology behind them.
Okay, so we've covered liquidity traps, market maker manipulation,
Yeah.
the three drives pattern, the morning trade strategy, and this
Yeah.
fascinating power of three concept.
Yeah.
The book also talks about the importance of the economic calendar.
Yes.
Why should traders, especially intraday traders, care about economic news and data releases?
The economic calendar is like a roadmap of potentially market-moving events. It's a schedule of all the major economic data releases and announcements that can impact the financial markets.
Okay.
Things like interest rate decisions, jobs reports, GDP announcements.
So these events can inject a sudden dose of volatility into the market.
Exactly. And that volatility can create opportunities, especially for intraday traders who are looking to capitalize on those short-term price swings.
Right.
The book emphasizes focusing on high-impact news events because those are the ones that institutions tend to exploit to their advantage.
So we're looking for those events that are most likely to shake things up,
Yeah.
create those big volatile moves.
That's the idea.
Okay.
And once you've identified those key events on the economic calendar, you can start to plan your trades around them.
But how do we actually trade around these events?
Right.
Do we buy the rumors, sell the news, or is there like a more nuanced approach?
Well, there's no one-size-fits-all answer.
Right.
The best approach depends on the specific event, the overall market context, and your own personal trading strategy.
Okay.
But the key takeaway is to be aware of these events,
Got it.
understand how they can impact the market,
Right.
and be prepared for a potential surge in volatility.
So it's like having a weather forecast for the market.
Yeah.
We know a storm might be brewing, but we need to watch carefully to see which way the wind is blowing.
Exactly.
Now, let's talk about another concept from the book that caught my attention, the Judas swing.
Oh, yeah.
The name alone is intriguing
Yeah.
and a little bit unsettling. What is this maneuver, and how does it trap unsuspecting traders?
The Judas swing is this deceptive price move that's specifically designed to trigger stop-loss orders
Okay.
and cause maximum pain for retail traders. It's like a siren song,
Okay.
luring them into a false sense of security before dashing their hopes.
So it's more than just a fake out.
Uh-huh.
It's a deliberate act of manipulation.
You could say that.
Okay.
And the book highlights a few specific places where these Judas swings tend to occur.
Right.
First, they often happen around key support and resistance levels.
Right. Those areas where we're already on high alert for shenanigans.
Exactly. Those levels become even more treacherous because of this tactic.
Okay.
Second, they often occur around previous highs and lows.
Okay.
The logic is that many traders place their stop-loss orders just above or below those obvious levels, making them easy targets.
It's like they're laying a trap,
Yeah.
using our own risk management against us.
Precisely. And finally, they can happen around order trap entries, or OTEs.
Okay.
Those price levels that look like attractive entry points, but are actually designed to lure traders into traps.
So basically, we need to be skeptical of any seemingly obvious entry point,
Right.
especially if it's near a key level or previous high or low.
Exactly.
But how do we actually spot a Judas swing in real time?
Well, the book gives a very clear visual cue look for a sudden, sharp run-up or run-down in price that quickly reverses course.
So it's like a head fake, a move that lacks follow-through
Yeah.
and quickly snaps back,
Uh-huh.
triggering those stops,
Right.
catching those traders off guard.
Exactly. And if you see that happening, especially around those vulnerable areas we discussed, it's a sign to proceed with extreme caution.
Okay, so vigilance is key. We need to be aware of those vulnerable areas.
Yeah.
Watch for those sharp, unsustainable moves that could signal a Judas swing in progress.
Right.
Now, the book emphasizes that to truly decipher the moves of smart money, we need to understand market structure.
Yeah.
What exactly does that mean?
So market structure is like the blueprint of the market, the underlying framework that helps us understand the current state of play and anticipate future price movements. It's about recognizing whether the market is trending up, trending down, or just stuck in a range.
So it's like a building's foundation. If the foundation is weak,
Right.
the whole structure's unstable.
Exactly.
How do we analyze market structure?
Well, the book stresses the importance of identifying key support and resistance levels.
Right. Those are the price levels where the market has historically struggled to break through.
Exactly. They act as battlegrounds between buyers and sellers.
Right.
And understanding those battle lines is crucial.
Okay, we've talked about those levels before, but it sounds like they're even more crucial when analyzing market structure.
Yeah.
What else should we be looking for?
The book also emphasizes the importance of using multiple time frames to refine your analysis.
So we're not just looking at the 5-minute chart anymore.
Yeah.
We're zooming out to the higher time frames as well.
Exactly. You want to look at the daily chart, the weekly chart, even the monthly chart to get a broader perspective.
Okay.
A support level that might look significant on a 5-minute chart might be completely insignificant when you zoom out to the daily chart.
So the higher time frames help us filter out the noise.
Yeah.
Focus on the levels that truly matter.
Precisely. And by combining multiple time frames, you get a much clearer understanding of the overall market structure and improve your entry and exit timing.
Okay, that makes sense. Now let's talk about another concept closely tied to market structure.
Okay.
Order flow.
Yeah, order flow is essentially the raw data that drives price action. It's the movement of buy and sell orders hitting the market.
Okay.
By understanding this flow, you get a sense of who's in control.
Right.
Where the big money's moving.
Okay.
And where potential breakouts or reversals might occur.
So it's like seeing the market's heartbeat.
Yeah.
The pulse of buying and selling pressure that's driving those price movements.
That's a great analogy. And the book focuses specifically on institutional order flow.
Okay.
Those large buy and sell orders placed by institutions that can move the market.
So we're trying to track the footprints of smart money.
Right.
See where they're stepping in and making their presence felt.
Exactly. By understanding their order flow patterns, we can anticipate their actions and potentially trade in the same direction.
Okay, but how do we actually analyze this order flow? What are we looking for on the charts?
The key, according to the book, is to observe which order flow is being respected by the market.
Right.
For example, if you see a large buy order come in and the market rallies, that suggests buyers are in control and the uptrend is likely to continue.
So we're looking for confirmation that the big money is backing up the move.
Exactly. And conversely, if you see a large sell order and the market drops, that indicates sellers are in control and the downtrend is likely to continue. It's about recognizing which side is winning the battle.
This is starting to paint a much clearer picture
Yeah.
of how the market really works.
Right.
We're not just looking at price action in isolation.
Right.
We're considering the forces driving that price action.
Right.
The intentions of those big players who are shaping the market.
That's the power of this book. It's about seeing the market through this new lens, understanding the psychology and the strategies behind those seemingly random price movements.
Okay, so we've covered market structure. We've talked about order flow. And the book also introduces something called daily templates.
Oh, yeah. Daily templates are like recurring patterns of price action,
Okay.
almost like the market's daily routine.
Okay.
By recognizing these patterns,
Yeah.
we can anticipate potential moves and position ourselves accordingly.
So it's like recognizing the market's habits,
Right.
its tendencies.
Exactly. And the book provides some interesting examples.
Okay.
One is the London swing to New York open-close reversal,
Okay.
which suggests that a price swing during the London session can often signal a reversal in the New York session.
So we're using what happens in one part of the world to predict what might happen in another part of the world.
Exactly.
That's fascinating.
Another example is the classic buy-sell day pattern, which helps you identify days with a clear bullish or bearish bias. Recognizing this pattern early in the day can make your trading decisions much simpler and potentially more profitable.
So it's like having a cheat sheet for the market,
Yeah,
a guide to those predictable patterns that repeat day after day.
that's a great way to put it. And by incorporating these daily templates into your analysis, you can gain a significant edge.
Okay, so we've talked about market makers' liquidity key patterns,
Yeah.
and now these daily templates.
Yeah.
The book also introduces the central bank dealers range, or CQR.
Right?
What is this exactly, and how do central banks influence the market on a daily basis?
The CBDR is a specific trading range that's influenced by the actions of central banks.
Okay.
Those powerful entities that control interest rates and money supply.
Right.
It typically occurs from 2:00 p.m. to 8:00 p.m. Eastern Standard Time
Okay.
and can be a really powerful tool for anticipating potential reversals or big moves.
Central banks, those are the big guys that everybody watches, but I never thought about their actions playing out so directly in the market.
Yeah, their impact is undeniable, and the book argues that the CBDR is one way that their influence manifests in price action.
Okay.
It's most reliable from Tuesday to Thursday when trading volume is generally higher.
So those are the days when the big institutions are most active,
Right.
and the CBDR becomes a more reliable indicator.
Exactly. By watching how price behaves within this range during those peak trading days,
Okay.
we can glean clues about where the market might be headed next.
So it's like a window into the actions of those big players, a way to see their footprints in the market. Okay, and now for a concept that sounds even more mysterious, the quarterly shift.
Oh yeah, the quarterly shift is this fascinating idea. It suggests that market sentiment can change significantly every 3 to 6 months,
Okay.
creating large-scale opportunities. Imagine the market having its own seasons.
Oh, wow.
Like spring, summer, fall, and winter,
Okay.
each with its own distinct character and potential.
So it's not just about those daily or weekly cycles, there are even bigger cycles at play.
Exactly. And the book provides tools like IPDA data ranges to help us identify these shifts.
IPDA data ranges, that sounds complex.
They can be, but the book breaks them down in a way that's surprisingly digestible. Essentially, they help us track institutional order flow and pinpoint those price levels where the big money is most likely to enter or exit the market.
So we're using these data ranges to anticipate those big sentiment shifts.
Right.
And ride those waves of change
Yeah.
that happen every few months.
Precisely. It's all about aligning yourself with the underlying forces driving the market.
Yeah.
And those forces often operate on a much grander scale than we realize.
This is starting to make me rethink my whole approach to trading. It's not just about finding the right indicators or patterns.
Right.
It's about understanding the market's rhythms, its cycles, and the players who are shaping those cycles.
That's the beauty of this book. It's opening our eyes to a whole new way of seeing the market.
Okay, so we've explored liquidity traps, market maker manipulation,
Yeah.
the three drives pattern, the morning trade strategy, the power of three, the economic calendar,
Right.
the Judas swing market structure, order, flow daily templates,
Yeah.
the CBDR, and even the quarterly shift.
It's a lot.
That's a lot to digest.
Yeah.
Before we move on to the final part of this deep dive,
Okay.
I think a quick recap of the key takeaways would be helpful.
Yeah, that's a good idea.
What are 3 crucial things our listeners should remember from today's discussion?
Okay, so first remember that market makers play a significant role in shaping price action. They're not just passive facilitators.
Right.
They have their own strategies and objectives, and they use their power to manipulate the market to their advantage.
So we need to be aware of their game.
Right.
And not fall into their traps.
Exactly. Second understanding, liquidity is paramount.
Okay.
Market makers seek out those liquidity pools, those areas where stop-loss orders are concentrated, and they use them to trigger those cascades of selling or buying.
Right. By understanding how liquidity works and where those pools are likely to form,
Yeah.
we can avoid being caught in their crosshairs.
So being strategic about our entry and exit points, and especially about where we place our stop-loss orders, is crucial.
Absolutely. And third, remember to always zoom out and consider the bigger picture.
Okay.
Don't get so caught up in the short-term noise that you lose sight of the overall market context.
Right.
Analyze the higher time frames, identify the prevailing trend,
Yeah.
and use that information to guide your trading decisions.
Okay, so awareness of market maker tactics, understanding liquidity, and always considering the broader context. Those are 3 powerful principles.
Yeah.
But before we move on, if you could offer our listeners just one piece of advice, one golden nugget of wisdom to help them navigate these complexities of a market, what would it be?
That's a tough one. But I think the most important advice is to never stop learning.
Okay.
The market's constantly evolving, and so should you. Right.
Read books like the one we're discussing. Take courses, attend webinars, and most importantly, spend time analyzing charts and observing price action.
Right.
The more you learn, the better equipped you'll be to make informed decisions and navigate the challenges and opportunities that the market throws your way.
That's great advice. The market rewards those who are constantly learning and adapting. It's not a destination, it's a journey.
Exactly, and the more you learn, the more exciting that journey becomes.
All right, so we've laid a solid foundation with those core concepts.
Yeah.
But now let's shift gears and dive into some specific tactics and patterns that can really help pinpoint those high probability setups.
Let's start with breaker blocks.
Okay.
These are powerful price action patterns that often signal a potential trend reversal or a continuation of an existing one.
Breaker blocks. The name makes them sound kind of like a force of nature.
They can be. Essentially, a breaker block forms when the market breaks through a key level with strong momentum. It's a decisive shift in control.
Okay.
Almost like a dam breaking.
I see.
The book highlights specific characteristics to look for, like the size and shape of the candlesticks, the volume accompanying the move, and of course the overall market context.
So we're looking for those explosive moves that punch through those key levels.
Exactly. But here's where it gets interesting.
Okay.
The book emphasizes that market makers often anticipate these breakouts and use them to their advantage.
I'm starting to see a pattern here.
Yeah.
It feels like every time there's a potential opportunity,
Right.
they're one step ahead waiting to exploit it.
That's the game.
Right.
Market makers might ride the wave of the breakout,
Okay.
or even more cleverly, they might fade the move.
Fade the move. What does that mean?
It means betting against the breakout,
Oh,
anticipating a reversal.
got it.
They might use that initial surge to unload their positions.
Oh, wait.
Or even start accumulating in the opposite direction.
So they're using the breaker block as a trap, knowing that many traders will chase those breakouts.
Exactly. It's a reminder that even seemingly strong signals can be manipulated.
Right.
But by recognizing those signs of a breaker block, understanding the market context and anticipating that potential for a fade, you can avoid becoming the victim.
This is all about thinking like the market makers.
Right.
Seeing the market through their eyes. Now, the book also talks about order blocks.
Yeah.
How do those differ from the breaker blocks?
Think of order blocks as those price levels where institutions have placed their big buy or sell orders.
Okay.
They represent areas of significant supplier demand and can be powerful magnets for price action.
So it's like seeing a giant institutional footprint on the chart, showing us where the smart money is most active.
That's a great way to put it. Unlike those explosive breaker blocks,
Right.
order blocks are often marked by these periods of consolidation or sideways movement.
So we're looking for those areas where price has been bouncing around within a range, suggesting that institutions are quietly building positions.
Exactly. And the book provides specific criteria for identifying valid order blocks.
Okay.
The size and shape of the candles, the volume, and the presence of certain candlestick patterns all offer clues.
It's like we're learning to read the signs,
Yeah.
the whispers of the market. But just like with the breaker blocks,
Right.
I imagine there's a layer of manipulation we need to be aware of.
Yeah, you're catching on.
Right.
Market makers might use those order blocks to trigger stop-loss orders, engineer breakouts, or even fade the move just like they do with those breaker blocks.
Okay, so the lesson here is that no pattern or signal is immune to manipulation.
Right.
It's all about understanding the broader context, the potential for manipulation, and learning to read between the lines.
That's the path to becoming a truly savvy trader.
This has been an incredible deep dive.
Yeah, it has.
We've uncovered so many powerful concepts and strategies. It feels like we've peeled back the layers of the market and glimpsed those inner workings,
Yeah.
the secrets of the smart money.
Absolutely.
I hope our listeners feel empowered to take this knowledge and apply it to their own trading.
Me too.
Remember, the market rewards those who are constantly learning,
Yes.
adapting, and refining their skills.
Right.
Keep studying, keep practicing, and never stop seeking those aha moments that can take your trading to the next level.
Absolutely.
And on that note, we'll wrap up this deep dive. Until next time, happy trading, everyone.